Hi there. Recently I had a question come up about what is reasonable comp and how do you determine reasonable compensation for an S corporation owner? Now, being a CPA, I get a number of tax returns that come in that I see that are prepared from other people when I pick up a new client, and sometimes I see that they've taken a $10,000 reasonable compensation on those returns. Sometimes when I look at that, I'll agree that 10,000 probably was reasonable, and other times I'll look at that and say, yeah, 10,000 was probably a little too low. So the reason why reasonable compensation is an issue and something that we look at when we deal with S corporations is because when you own an S corporation, all of the income that comes in from that S corporation is not subject to employment taxes versus an LLC, let's say a sole proprietorship or a partnership, where all of your income is subject to both income tax and employment taxes. S corporation income is only subject to income tax, but not employment taxes. Now, because of that, the IRS requires S corporation owners to take out a salary, which they are charged employment taxes on. They pay employment tax on the salary that they take out of their S corporation. Now, is what people try to do to get that tax as low as possible is they take as low of a salary as possible. And sometimes that ends up being $10,000. And when you take a $10,000 salary out, you're only paying roughly $1,500 in employment taxes. Versus if you took a $100,000 salary out of your S corporation, you're paying $15,000 in employment taxes. So, and that's per year. So that's an $8,500 difference per year by having a $10,000 salary versus having a $100,000 salary. So what would enable somebody to take out a $10,000 salary? Or what would require them to take out a $50,000 salary or a $100,000 salary? Well, it's all based on what is reasonable compensation. What would somebody reasonably pay themselves? And there's two ways to determine reasonable compensation. Number one is what I like to call similar compensation or similar comp. What similar compensation is based off the standard of what you would pay somebody to do your job. So if you were just going to retire or step aside and hire somebody to come in and do your job, what would you pay them to do your job? Would somebody take your job for $10,000 or would somebody take your job for $100,000? That's one of the standards that you could look at. The problem with that standard is it's a little subjective, and unless you're actually going out and hire somebody, and looking at employment studies and compensation studies and things like that, it's hard to really say, yeah, I'd pay somebody $100,000 to do my job, or $50,000, or $10,000. So another option to do is what I call the market rate. Now, the market rate is nice because it gives you a really good idea of what somebody would be paid to do your job. And this is done by 4 criteria that go into it. Number 1 is location. And then we have the function, what functions are being performed. Then we have the proficiency of performing that function, and then we have time spent doing that function. So is what the market rate does, it says, okay, based on your location, so you would look at where you work. Do you work in Los Angeles? Do you work in New York? Do you work in Louisiana? Do you work in Colorado? Where exactly do you work? What is your work location? And specifically, what is the city of that location? So if you're in Colorado, are you in Denver or are you in Steamboat Springs? Those areas are going to be 2 different rates of income based on what people are doing. Then you look at the function. What function are you performing? I am a CPA and I own a CPA firm, but I certainly don't spend all of my time doing CPA type work. I'm not always doing tax returns. I'm busy with things like marketing. I'm doing my own bookkeeping. I'm doing a number of other things. We have employees. I'm managing staff. I'm hiring people. So I'm a hiring manager in one side. So I have all these different functions that I'm performing. Then we go through the proficiency of performing those functions. So for me, my CPA function is pretty high. I've been doing it for a while. I know it pretty well. But my hiring manager function is pretty low. It's not something I do very often. Same thing with marketing and things like that. It's not something that I've gone to school with it. I don't have a degree in it. I don't work in it necessarily every day, so my proficiency gets low. And then you look at the amount of time that is spent performing that function. So as an example, I'm a CPA. I'm located in Salt Lake City, Utah. My function is, let's say I'm preparing a tax return. My proficiency in that is high. So then we go to the Department of Labor Statistics and we say, okay, for somebody that's performing tax preparation function in Salt Lake City, Utah, and has a high proficiency, what is the amount of salary that they would be paid for that? We come up with what that hourly salary is. We times that by the amount of time that's performed during that year. So let's say I do tax return preparation 1,000 hours a year. So I'd come up with my rate using location function proficiency. I'd times that by the amount of hours that I spend doing that year. And that is my reasonable salary for performing that one function. Then we go and we look at a marketing type function. So if I'm performing a marketing function in Salt Lake City, Utah, and my proficiency is, say, low to medium, and I spend 200 hours a year doing that, then that gets me what my reasonable salary is for performing that marketing function. Now, the way that this market rate works is it's based on the functions that you perform. And if you looked at your business and you'd say, okay, I'm going to perform the same functions, whether my business is making $100,000 or my business is making $1 million, maybe that's true, maybe that's not, it depends. As businesses grow, your functions probably expand and get a little different. But let's say everything equal, that you're performing the same functions when your business is making $100,000 as it is making $1 million. Well, then your reasonable salary would not change because your business is making more income. In fact, that's when the IRS kind of looks at manipulation of your salary. If it's going up and down when your income is going up and down, that's a problem because the IRS recognizes that you should be performing functions and being paid based on the function that you're performing, and that's not necessarily going to vary from one year to the next. So the IRS likes to see those salaries maintained pretty closely to what they are. Sometimes we see business owners that want to jack them up really high for a year so they can get more retirement money going in or do something else and then bring it back down the next year. You run a little bit of risk of the IRS not liking that. You also run a risk if your salary is $10,000 and it should be more like $50,000, $60,000 or $100,000 or whatever that might be. So these are really helpful to go through and see what exactly your reasonable salary would be.